Hey friends, welcome to the Singapore Market Digest for April 29th, 2025. I'm Iggy from the Investing Iguana, and today we're diving into what's been happening on the SGX. Let's kick things off with a quick look at the overall market mood. While the Straits Times Index, STI, wasn't specifically mentioned in today's news, the stories we're covering show a market that's a bit mixed. Some companies are seeing growth and optimism, while others are facing headwinds or holding steady. First up, let's talk about Capitaland Ascendas REIT, or CLARE for short. If you're not familiar, CLARE is one of Singapore's largest industrial and business space REITs, with properties across Singapore, Australia, and other regions. In their latest update, CLARE reported an 11% growth in portfolio rental reversions for the first quarter of 2025. That means, on average, they're signing new leases at higher rates compared to the old ones, which is a positive sign for income growth. However, there's a catch. Overall occupancy across their portfolio dipped by 1.3% quarter on quarter. Australia saw the biggest drop, with occupancy falling by 3.3% to 89.2%. Even with this dip, the market seemed to take the news in stride. CLARE's units closed up 0.8% at $2.68 on Monday. So while there's some pressure on keeping their properties full, the ability to raise rents is helping support their performance. Next, we have SATS, a name you'll recognize if you've ever flown out of Changi and had a meal on the plane or checked your bags. SATS is a major player in in-flight catering and ground handling. Their subsidiary, Worldwide Flight Services, WFS, just announced a big partnership with the Port Authority of New York and New Jersey, plus investment manager RealTerm. Together, they're opening a brand new $270 million cargo terminal at JFK Airport in New York. This is the first new cargo terminal at JFK in 30 years, aimed at reducing congestion and making cargo operations more efficient. While the news broke after the market closed, SATS' shares finished flat at $2.81 on Monday. This move could position SATS for more growth in the US, but we'll have to watch how it plays out in future quarters. Moving on to Frasers Centrepoint Trust, or FCT. FCT is a retail-focused REIT with a portfolio of suburban malls that many Singaporeans visit for shopping and dining. The trust just posted a small but steady 0.5% increase in distribution per unit, DPU, for the first half of their financial year, up to $654 from $662 a year ago. Distributions to unit holders also rose by nearly 5% to $110.1 million. That's good news for income-focused investors, as it shows FCT's ability to keep growing payouts even in a challenging retail environment. The DPU for this half will be paid on May 30th, so mark your calendars if you're a unit holder. FCT's units closed unchanged at $2.25 on Monday. This stability suggests the market sees FCT as a reliable, steady performer, especially for those seeking regular income. Let's turn to First Sponsor, a company involved in property development, mainly in China. The first quarter of 2025 has been tough for them, with weak market sentiment continuing to weigh on their business. This is despite the Chinese government rolling out pro-market fiscal and monetary policies in the second half of last year, hoping to give the sector a boost. First Sponsor remains cautiously optimistic, expecting that further government support in 2025 could help the market recover gradually. Their shares actually rose 3.8% to $1.09 on Monday, even before this news was released. That suggests some investors might be betting on a turnaround, or at least see value at current prices. But as always, the property sector in China remains a space to watch closely. Finally, let's check in on Stoneweg European Real Estate Investment Trust, or Stoneweg eREIT for short. This REIT invests in European commercial properties, giving Singapore investors a way to diversify overseas. For the first quarter, their distribution per unit, DPU, fell 3.7% to 3.374 euro cents, down from 3.505 euro cents a year ago. That's despite a 2.4% increase in net property income to 33.5 million euros, thanks to higher rental income and a reversal of some bad debt provisions. Gross revenue was also up slightly, with stable leasing activity helping to support income levels. The market seemed to react positively, with Stoneweg eREIT's units rising 2.3% to $2.21 on Monday. This shows that while payouts dipped a bit, investors may be encouraged by the underlying stability and income growth in the portfolio. To wrap things up, today's SGX news shows a mix of resilience and challenges. Some REITs are managing to grow distributions or raise rents, even as occupancy or payouts face pressure. Companies like SGX are making bold moves overseas, while property players in China are still waiting for a stronger recovery. As always, keep an eye on how these trends develop, and remember, every investment comes with its own risks and opportunities. That's the scoop for today. Remember to do your own research before making any investment decisions. This is Iggy from the Investing Iguana, signing off.